Well, welcome to the January 2025 edition of the Beyond Wealth Advisors Economic Update. We are back for another year, and with me again is J.C. Ganote.
Good morning, John.
Good morning, J.C. Good to see you again.
You too as well.
Welcome to the new year.
Happy New Year. It's a new year.
It is a new year, and things are already off and running.
New things happening.
Absolutely. It just seems to go by faster and faster each and every year. So, well, we're back for another round of economic updates. And gosh, a lot's happened since December, at least it feels like it has. And, you know, if you think about post-election, end of the year, gosh, investor, business, consumer confidence has just been at an all-time high. It just seems like the anticipation for 2025 has just been fantastic. Now, the question is that we're going to start off with today is that confidence being masked by some underlying risks? In other words, should we tamper our enthusiasm just a bit?
It's a really, really good question, John, because there is always seems to be a little bit of an air of confidence in the market for the most part. But I think one of the things that could be at risk in that confidence, of that overabundance of confidence right now, is we've seen the 10-year Treasury note continue to move higher. And the 10-year Treasury note's moving higher because they're not so sure that inflation is under control.
Well,
and so,
what, inflation? I thought we were done with inflation.
I know. Well, it's not. At the lowest point last year, the 10-year Treasury note got down to 3.62% in October and has moved up a full percentage point to about 4.7 as we speak today.
Wow.
And so that can undo the confidence of the market because of higher rates and competing with equities and the bond market as well.
Right. Yeah. And, you know, obviously the Fed does have a mandate. We hear about this a lot to get inflation down to 2%. We're not down to 2%.
Right.
And we've also been talking about this for some time now, that it's one thing to take the top end of inflation off, but to get to the last bit of that is always the tricky part. And there's a lot of other moving parts, you know, going on right now too. Obviously, new administration, potentially new economic policies. We'll maybe find out here the next update if any of those have been put in place yet or not. But all of that's really coming into play as we think about how inflation and interest rates and all of this is going to impact 2025.
Exactly, John. Well, it's interesting. We're talking just briefly about the inflation picture right now because this morning, if you've seen the news this morning, the CPI number came out for the month of December. And actually, the core number ticked down 0.1%.
Right.
So it was cooler than expected. And so that's the first tick down in core CPI since July of last year.
Wow. Yeah.
So it really it is looking like what the Fed's beginning to do is beginning to work.
Right.
And we saw a reflection in the bond market today, drop down to about 4.65 on the 10-year, and the stock market's off to the races.
Yeah, absolutely. So I guess that means we're going to have double-digit returns again on the S&P. Just keep rolling, right? Plus 20.
It's hard to say. It's hard to say. It was kind of hard to think that we would have 2 years back-to-back of over 20% gains.
Right.
You typically don't have that often, that strong of years back-to-back. But you still could have a really strong year.
Yeah.
I mean, especially with the broadening out in the market, I mean, we could still have a decent return overall.
Yeah, you bring up a great point, JC. You know, it feels like the last year the growth that we had was really fueled by just earnings and just opportunities for companies to be profitable again, and just the excitement that came from that. But it was pretty narrow. And when we talk about the market being broad or versus narrow, of course, the last 2 years, all we've heard about is the Magnificent Seven and technology and AI and how these stocks have really driven the growth. So is that going to continue, or do we actually see a broadening? Have we seen a broadening, and do we think that'll continue?
We are seeing a broadening, but keep in mind, with interest rates, it has a big effect on small and mid-cap stocks. And we've seen a pullback there, especially in the Russell 2000 since the beginning of the year. And we are seeing some bit of a rotation right now, not exactly knowing what the new administration's policies are going to be on tariffs. We are seeing technology have a really tough start to the year so far. Not that it's not going to be a good sector to be in. We see a lot of rotation out of some of the stuff that was working, and we are seeing it going into right now healthcare and quite honestly energy and financials. Energy's on a tear right now. You know, the gas prices on a price per barrel of oil, it's up around $75, $77 a barrel now, and that's up over almost $10 a barrel in the last month.
Right.
So there's some rotation going on.
And you touched on a couple of things there. There's really two different ways that the market can broaden out. We talk about the sectors. So there's really 11 different sectors in the U.S. economy. And so we see that as one way that the market broadens. And we also see it in terms of the size of companies. And you mentioned that as well with the Russell 2000. And just oftentimes when a market and economy does recover, we see the small and mid-sized companies really do well. They feel like they just haven't really got a chance to get going yet. You know, interest rates haven't quite come down, and they really want to take off, but they just haven't been able to. So what do you think, 2025 bodes for, kind of that
I think
segment
really
of the capitalization?
It's something we definitely need to keep an eye on, because it is a sector that's important to the overall market itself. And I think what could kind of come into play there that we really haven't talked a lot about over the last number of months is the geopolitical influences that go into some of those small cap and mid cap stocks. The geopolitical concerns of some of these wars that we're fighting right now maybe coming to an end.
Wow.
I mean, there's a lot of promise out there right now so if we get some ceasefire going on in the Middle East and other places, we could begin to see a bigger broadening out, bigger rally in some of those small and mids.
And not just U.S.
And
too.
European, exactly.
International
Absolutely.
as well. Well, that's a lot. And obviously we're excited for the new year for lots of reasons. And we look forward to bringing you updates throughout the year. So let's kind of bottom line it. So as we sit here mid-January, it feels like in general we have a pretty positive outlook for 2025.
Absolutely. We do.
And feel good about kind of the overall direction we're heading. I do think it's important to remember that pullbacks are common, right? We've had a little bit of a one.
We get
even just
typically
in the last
3 to 4
weeks.
pullbacks a year at 5%, 5 to 6% in nature, 3 or 4 times a year. It's not uncommon.
Absolutely. And, I think it also is important, even just on the heels of our conversation about broadening, just to be reminded of the importance of diversification, having good fundamentals, thinking through how you select your investments and how you put together your portfolios. All of that really matters when you really stop and think about how to manage risk and also stay diversified, but at the same time participate in that growth.
Exactly, John. I think you're hitting it right on, because I think this year the number one of the main things I would reiterate to a lot of my clients is the fact that it's really goes back to, again, time in the market and not timing the market. And if
it almost sounds like you've been an advisor for a while.
If you were trying to time the market right now, say the first month of this year so far, you wouldn't have done very well.
Wow.
Because you'd have been setting this big rally out right now, probably we're having today, because you were trying to time things.
Right.
And we saw last year, again, about the last 4 to 5 months out of the year were the best months in the market.
Right.
And if you would have missed out on that. So it's just, like you said, be well diversified, have a strategy that matches your timeline, and just stay in the market.
Yeah. That's really good information, JC. Appreciate that.
Simple but powerful.
Absolutely.
It's a simple thing, but really powerful.
Absolutely. Well, fantastic. Well, I think with that, we'll wrap up the January edition of the Beyond Wealth Advisors Economic Update. As always, it's a great time to reach out to your advisor. First of the year, taxes are around the corner.
We're getting a lot of that. We're getting a lot of people reaching out right now, which is good. We want to hear. We want to hear from them.
Absolutely. And gosh, we'll be at the end of the first quarter before we know it. So with that, thank you. And we look forward to coming back next month.
Thank you, John. Appreciate it.